Silver is back up over 59, this afternoon after Warsh started speaking, and gold's up $60. We had negative mornings in the metals and big reversals in the afternoon, particularly with the Fed meeting. My target now for gold is 7,000. My target for silver is 200, and I think we see those this year. I do think the mining companies are making money in a big way now that they haven't in years. Seeing cash flows there they never saw before, and there's demand from sovereign, particularly in gold. There's industrial demand for silver, and all kinds of AI and EV attracted a lot of retail buying that was kind of saw the shiny object of momentum and jumped on, but they jumped on very late. This in equities. Equities, I think, are, sometime this year are putting in a 44-year secular top. All the stuff I just said about Kevin Warsh is correct in theory, but unfortunately, I fear we are heading for a global bust that's going to change. It's going to force his hand and force.
When it comes to the precious metals, a lot of people are concerned about precious metals falling further from here, but it sounds like with the Fed meeting and them holding interest rates steady, you're thinking that this is probably pretty close to the bottom in all the markets.
Yeah, I think probably I'm more confident probably in the metals than I am in stocks in terms of the exact bottom. We haven't seen enough of a turn yet in equities to be sure, but boy, the reversal in the metals and the miners today is pretty convincing. And I think and prior to that, I saw a lot of things falling into place that told me I think we bottomed 9 trading days ago, and the silver got down under 55, just under 55, scared the heck out of everybody. And then there were, as always happens in these sell-offs, you get the technicians who jump on the momentum bandwagon, and they always have a lower low that it has to get to before it can turn. And you have all the retail investors and maybe others that listen to that, and then all of a sudden say, yeah, we can't have a bottom until we get to this. And it almost always, they have you waiting for a bottom that doesn't come, and then it turns before that, and you end up chasing. So I think we may see that again here. Silver is back up. I'm not sure where it is right now, but it was back over 59 this afternoon after Warsh started speaking, and gold's up $60.
Most investors panic exactly when institutional positioning begins quietly improving. According to David Hunter, the sharp reversal after silver briefly fell below 55 may signal fear has already done its job. Markets often bottom before consensus technicians receive confirmation, leaving late sellers trapped while stronger hands accumulate. For investors protecting wealth, chasing headlines instead of positioning can become the most expensive mistake. Next, David Hunter reveals why today's rebound may contradict the bearish chart patterns dominating financial media.
So we had negative mornings in the metals and big reversals in the afternoon, particularly with the Fed meeting. I think there's a very good chance that we are in the beginning of that reversal. And my call has been and remains that we are going to much higher highs in both gold and silver. My target now, which was raised, I think, back at the end of May, my target now for gold is 7,000. My target for silver is 200. And I think we see those this year. So, nothing has to happen by any specific date, but there's a pretty good chance that it's going to be another steep run like we saw last December and January, meaning you could get, go from, the high 50s in silver and 4,000 in gold and be at those levels in a matter of a few months, 3, 4, 5 months.
A lot of people are looking at the silver chart and are concerned that since late January, early February, a big sell-off and this consolidation, it mirrors very similar to what happened in 2011. But it sounds like maybe this would be more mirroring what happened in 2008, or what is your perspective on that? Just looking at the charts, it's kind of concerning. I guess people are thinking, well, couldn't we be at these levels for years until we actually make a new all-time high?
History rarely repeats perfectly, but timing often exposes where the crowd is looking the wrong way. David Hunter notes that comparing every silver correction to 2011 may ignore how today's macro backdrop differs dramatically. Institutional capital responds to liquidity cycles, not visual chart similarities, and that distinction could reshape expectations faster than most anticipate. Investors focused only on historical overlays may overlook a changing cycle altogether. Next, David Hunter exposes why today's setup may resemble a liquidity reset rather than a prolonged precious metals stagnation.
Yeah, I don't really draw that comparison, so it's hard for me to say whether it's one or the other. I don't think it's either one necessarily, but I do think we are in a very different time than we were then, economically, and keep in mind, 2011 we came off the 2008-9 period, had a big run up in silver and gold, but we've both technically and fundamentally, I think we're in so much different place now. The prices are obviously much higher now. The mining companies are making money in a big way now that they hadn't in years, maybe ever. You're seeing cash flows there that you never saw before. And there's demand from sovereign, particularly in gold. There's industrial demand for silver, and all kinds of AI and EV, et cetera. So I just don't think we're at all in the same fundamental or technical place as we were back then. Like I said, when you get a run-up like we had, and people forget, silver was, I guess probably back in the fall, down around 30 and ran from 30 to 122 in 6 months or whatever. And then, and a lot of people weren't paying attention to it when it was in the 30s and 40s, when it broke out above its all-time high of 48 or 9, and ran quickly from there to 122 in, less than 3 months.
Markets keep comparing today's cycle to 2011, but the underlying drivers have fundamentally changed. What David Hunter is highlighting is that sovereign demand, AI-driven silver consumption, and mining cash flows create a backdrop that never existed during prior peaks. Retail investors focusing only on chart history risk missing the structural forces institutions are already pricing into long-term allocations. Next, David Hunter reveals why industrial demand could overpower the bearish narrative surrounding precious metals.
It attracted a lot of retail buying that was kind of saw the shiny object of momentum and jumped on, but they jumped on very late. So what you had was then the quick reversal, because it had gone parabolic, corrected 50%. And I thought that was the correction. It went down to 62, I think, in March. It doubled, basically went back to that same 62 level in May, and I thought that was a double bottom, and you'd go. Once it broke that scared all kinds of people that were big silver bulls as well as, weaker hands. And that's where the technicians started jumping in and saying, we broke it down. We're going to 50. We're going to 40. I don't buy any of that. I think it's the classic case of what happens at a bottom. And I just think fundamentally and technically, this thing has a long ways to go. And again, the difference between this and equities, I think, are putting in sometime this year, putting in a 44-year secular top, much higher levels than here, but a 44-year top is a big top. And whereas silver and gold, I think, they could top out this year for this cycle, but next cycle they'll go much higher. I have a 20,000 target for gold by the, say, 2032 or 3, and 1,000 target for silver. So the tops this year are cyclical tops. The top this year in equities is a secular top. Very different.
Retail investors often buy momentum just as experienced money quietly starts distributing risk. David Hunter's argument suggests the recent breakdown resembles a classic shakeout that transfers metal from emotional holders to stronger hands. Meanwhile, he separates a cyclical precious metals peak from what could become a multi-decade top in equities, a distinction many commentators ignore. Next, David Hunter exposes why institutional capital may abandon stocks long before the public recognizes the shift.
As we enter this final melt-up and bust phase, how do you anticipate the Fed reacting to that? I know in the past, I think this may have been a conversation we had about a year ago, you were expecting the base money supply to increase during the bust for the Fed to, kind of bail everything out. It increased to about 20 trillion. What is your current view on where the base money supply could go and how the Fed is going to be reacting to the bust?
Yeah, so I want to preface it by saying all the stuff I just said about Kevin Warsh is correct in theory, but unfortunately, I fear we are heading for a global bust that's going to change. It's going to force his hand and force anybody who would be in that position's hand. And so I still believe we're heading for a global bust. It keeps getting pushed out because the cycles remain strong. But I thought there's signs under the surface that say next year could be a rough year globally. And certainly the oil situation exacerbates it, whether we're mostly behind us or not. If it isn't, that certainly will exacerbate it. But I think there are signs of a global bust being here next year. If that's the case, ultimately a bust is something I'll define just very simply as worse than 2008-9. There's more to it than that, but and it means that you'll have, because of the massive leverage in the system, you'll have a massive unwind.
The Fed keeps promising discipline while the financial system grows increasingly dependent on intervention. This is where David Hunter's thesis shifts from policy theory to market reality, arguing that a severe global downturn could force officials to abandon their own principles. If leverage begins unwinding rapidly, protecting purchasing power may matter more than chasing conventional assets. Next, David Hunter unravels why future Fed actions could directly contradict today's public messaging.
Leverage, once you start heading into a recession, things start rolling downhill, that leverage really kicks in and causes financial crisis. So I think that's what we could see next year. And if we do, it's going to force the Fed's hand. It's not going to be steady as she goes. It's going to be, we need to do it. My concern is, because of what happened in 2008-9, because of the pandemic in 2020-21, where we printed a lot of money, we expanded money supply big time and expanded the debt big time. My fear is, because it's everybody said it, Powell said it, Warsh has in one way or another said it, they don't want to go back there. Warsh wants to shrink the balance sheet, which is probably 6.7 trillion now, down from 9. He wants it back to a normalized place where it might be 2, 3, 4 trillion maybe. It was 875 billion going into 2008's crisis, in October 2008. So we've gone from 875 billion to 9 trillion back to 6.7. I'm saying you could get to 30 trillion because a bust is going to require it. But, Powell said we don't want to ever go back there. That was very bad policy. We want to normalize the balance sheet. We don't want to do zero interest rate policy again. We don't want to just print money willy-nilly or QE infinity. I think Warsh is in the same boat.
The bigger the debt burden becomes, the fewer choices policymakers actually have. According to David Hunter, officials may publicly reject another massive expansion of the balance sheet, yet a deeper crisis could eliminate every alternative. Investors trusting policy promises instead of financial incentives risk misunderstanding how quickly emergency measures return. Next, David Hunter reveals why balance sheet expansion may become unavoidable despite repeated official denials.
So that's where their head is at. But it's a very different story when you're faced with a free-falling financial system worldwide, and the only solution you have is money. And it takes time to get that money to a level, what I call right-size policy, that stabilizes things and turns it back up. They're going to be early on in let's say, a recession, and then what's moving towards a bust. They're going to be reluctant to do what in past times we would have done, because they're fighting that war that the last war of 2008-9 or 2020. And so they're going to be slower to react, not quicker. They're going to be, and if we're looking at, if I'm right, this global bust is going to be bigger than 2008-9. That means you should need a bigger response than either 2008-9 or 2020. And in fact, they're going to be wanting to do much less. That means there's going to be a period of time, probably months, where they're going to be behind the eight ball and slow to respond. They'll be putting money in. They just won't be putting in nearly enough to stabilize things. And then they'll, a month later, they'll say, well, we got to do more. And they'll do some more, and then they'll do some more. So it's going to take many, many months, I think, to get to a right-sized policy. And in the meantime, things are going to be heading south in a hurry. So that's my fear. Whether it all plays out that way or not, we'll see.
Delayed intervention has historically amplified financial stress rather than preventing it. David Hunter notes policymakers may hesitate for months before deploying enough liquidity, creating a dangerous window when markets reprice far faster than official responses. That leg can punish retirement accounts, savings, and portfolios before emergency measures finally arrive. Next, David Hunter exposes why the Fed's slow reaction could become the biggest catalyst for precious metals.
But my viewpoint hasn't changed at all. And yet, you heard me sing the praises of Kevin Warsh. It's not really, it's circumstances. It's where we are in the big picture. It's where we are in what I call a super cycle. We've just levered up the system cycle after cycle after cycle, going back to the Great Depression from World War II on. And each successive cycle, pretty much, we've gotten more levered and more extreme in terms of imbalances and what it takes to crank it down because of inflation or what have you. Now you're in a place where it's a very fragile system, partly because of the pandemic, partly because of all the leverage, and a very leveraged system. And yet you've got policymakers thinking in less extreme ways. They're just, so they'll get there. They'll be forced to get there. It's just a question of at what breaking point do they get there? How far down do we go before they really all of a sudden, have deer in the headlights eyes and go, we got to speed this up. We got to get a lot more in there than we've been doing. It's hard to predict, but in the meantime, you could have a pretty big bear market and then lots of casualties in the financial industry as they wrestle with what to do.
Well, David, it will be very interesting to continue to track this with you.
Every rescue has made the financial system more dependent on the next rescue. What David Hunter is highlighting is that decades of rising leverage have created a fragile structure where small policy mistakes carry enormous consequences. Investors relying on historical stability may underestimate how quickly confidence can disappear once liquidity dries up. Next, David Hunter reveals the hidden breaking point policymakers hope markets never reach.
Are there any last thoughts you had, and can you tell us a bit about your newsletter that you provide?
Sure. Yeah. Just the last fall thought. We didn't talk too much about interest rates. We talked about Fed policy, but I believe the bond market is in a bottoming phase here. It's been a 2 3/4 year bottom. That's a big bottom. It's been skating along that level for all that time. Obviously, the 10-year got up to 5% a year ago or more, and it's come down from there. But it's backed up from 4% back to 460, almost 470, and I think that's pretty much the high water mark. If I'll be surprised if it's not, and I think we start rolling over here very soon. Maybe starting with the policy today. Not that the Fed's driving it; it's more comfort that the Fed's not raising rates. But it'll start slowly. But ultimately, I think because of a global bust next year, you could have the 10-year get down to 0%, as crazy as that sounds, because at the point where the Fed finally jumps in a big way, the way you create QE is by buying treasuries from treasury bonds from the banks. they're going to be buying every bond they can get their hands on if we're going to be putting 20 trillion into the system.
Most strategists expect higher yields, yet major turning points often emerge when consensus feels safest. David Hunter's argument suggests long-term treasury yields may have already peaked despite persistent inflation fears dominating headlines. If bond yields collapse during a crisis, gold's opportunity cost falls, while traditional assumptions about safe assets quickly unravel. Next, David Hunter exposes why falling yields could become the strongest bullish signal for precious metals.
So rates, I think, are at a high water mark here. You've got a lot of people out there. I'm pretty contrary on this right now, but you got a lot of people out there in the bond market, among strategists, talking about higher rates. In some cases, much higher rates from here. I'm the opposite. I think we are at the high water mark and we'll head down ultimately to zero, but in the meantime, it'll find its way to 4% on the 10-year and then 3%. And then from there, once the Fed kicks in with all the monetary policy, the monetization of bonds, you'll see it run pretty quickly, I think, from 3 down to 0, meaning over a course of 6 or 8 or 9 months. So I just wanted to get that in there because we hadn't talked much about rates.
The bond market may be signaling something policymakers still refuse to acknowledge publicly. This is where David Hunter's thesis shifts by arguing that rates could ultimately fall towards 0 as aggressive monetization returns during a severe downturn. That scenario would expose how temporary today's hawkish messaging really is, and why wealth preservation becomes increasingly important.